Forget about chasing those risky high-yield ETFs that always seem too good to be true. In the next few minutes, I'm going to show you how to build a rock-solid passive income portfolio for 2026 with just 3 simple ETFs you can pretty much buy and hold. This is all about getting that consistent income without all the stress. Are you tired of looking at funds that promise a huge monthly payout, only to realize they might be slowly draining your initial investment to do it? Yeah, that's a classic yield trap, and building real lasting passive income shouldn't feel like you're walking through a minefield. It's an easy mistake to make, and it can cost you a ton of money down the road. You need a strategy that's built on safety and consistency. That's why I'm a huge fan of a simple 3 ETF portfolio. It's efficient, it's diversified, and it stops you from chasing every hot and often dangerous trend that pops up. In this video, I'm going to break down the only 3 dividend ETFs you need to build a solid foundation for your financial future. The anchor, Vanguard Dividend Appreciation ETF. Ticker VIG. First up is the anchor of our portfolio, the one designed for safety and steady growth. It's the Vanguard Dividend Appreciation ETF, ticker symbol VIG. Think of VIG as the bedrock foundation of your income strategy. Its main goal isn't to give you a massive yield right out of the gate. It's about owning high-quality companies that have a long history of increasing their dividends year after year. VIG tracks the S&P US Dividend Growers Index. Now, to get into this club, a company has to have a track record of increasing its dividends for at least 10 consecutive years, on top of other financial health screens. That simple rule is a powerful filter. A company can't keep giving its shareholders a raise for a decade unless it's financially stable and consistently profitable. This is what true dividend growth investing looks like. Now, its dividend yield might look a little modest. It often hovers around the high 1% to low 2% range, but you should always check for the most current numbers. That's by design. The fund intentionally avoids the highest yielding stocks to steer clear of those risky yield traps we talked about. You'll see powerhouse companies in here, often names like Microsoft, Apple, and Broadcom. With a super low expense ratio of just 0.06%, this ETF is a fantastic way to get long-term growth with dividend checks that just keep getting bigger over time. The income and growth engine, Schwab US Dividend Equity ETF, ticker SCHD. Okay, we've got our anchor for safety. Now let's plug in an engine that gives us both a bigger income stream and strong growth potential. For that, we're turning to the superstar of the dividend world, the Schwab US Dividend Equity ETF, ticker SCHD. This is one of the most popular ETFs out there for a good reason. It's a master at balancing quality, growth, and yield. SCHD tracks the Dow Jones US Dividend 100 Index. Its screening process is really tough. It starts by looking for companies that have paid dividends for at least 10 straight years, then puts them through a bunch of financial health tests, looking at things like cash flow, return on equity, and 5-year dividend growth. This leaves you with a portfolio of about 100 rock-solid blue-chip U.S. stocks. But here's the best part. SCHD usually offers a much beefier dividend yield, often sitting in the 3 to 4% range. Of course, this number moves around with the market, so make sure to check the latest stats before you invest. It does all of this while keeping that same rock-bottom 0.06% expense ratio. You'll find top holdings in resilient sectors, like healthcare and consumer staples, with familiar names like Amgen, Coca-Cola, and Merck often in the mix. For anyone who wants a bigger paycheck right now without giving up on long-term growth, SCHD is the perfect engine for this portfolio. The diversifier, Vanguard FTSE Canadian High Dividend Yield ETF, ticker VDY. We've got our U.S. growth and our U.S. income covered. Now it's time to add some geographic diversification with our third and final fund, the Vanguard FTSE Canadian High Dividend Yield Index ETF, ticker VDY. This ETF does 2 really important things for us. It gives us exposure outside of the U.S., and it pays dividends every single month. VDY tracks the FTSE Canada High Dividend Yield Index, which means it targets some of Canada's most generous dividend-paying large and mid-sized companies. A huge chunk of this fund is made up of Canada's big banks and top energy companies. We're talking about giants like the Royal Bank of Canada, TD Bank, and Enbridge. These sectors are famous for their stability and consistent payouts. The fund typically offers a pretty attractive yield, sometimes around 3.5% or higher, but again, that can change, so always verify the current yield. The monthly payout is a fantastic feature if you're planning on living off your investment income. The expense ratio is a little higher at around 0.22%, but that's pretty standard for an international fund. With its focus on stable, stable, income-producing sectors, VDY is the perfect way to round out our portfolio and add a steady monthly stream of cash. Portfolio allocation and strategy. So, how do you put these three together? A simple and popular way to start is with a 40-40-20 split. You could put 40% of your money into VIGI for that stable, long-term growth. Put another 40% into SCHD for that awesome combo of income and growth. Then, allocate the final 20% to VDY for international diversification and those monthly dividend checks. This split keeps your core in the US market, which is a global powerhouse, while the Canadian exposure adds another layer of safety and income. Of course, you can tweak these percentages to fit your own goals and comfort level. The real beauty here is the simplicity and the focus on quality. So, that's the strategy. A simple 3 ETF portfolio built to be a fortress of passive income for 2026 and beyond. By combining VIGI for dividend growth, SCHD for high-quality income, and VDY for diversification, you end up with a balanced and resilient portfolio that isn't chasing risky yields. This is a strategy built for the long haul, one that can help you sleep at night while your wealth grows steadily. Now I'm curious, what are your favorite dividend ETFs? Let me know in the comments below. I really do read them all. And if you got any value out of this video, do me a favor and hit that thumbs up button and consider subscribing for more simple, no-hype investing strategies. Thanks for watching, and I'll see you in the next one.